Welcome to the weekly update, where I'll go over the action in the market for the week of March 25th through the 29th, really the 28th, because the market was closed on Friday. And we'll look ahead to the week of April 1st through the 5th. We had another up week with the market, not very much. It's really the small caps that had a pretty good week. And that's what a lot of people are wondering about right now. We have all the other indexes, the Dow, the S&P, the NASDAQ 100, and even the mid caps are at or near all-time highs. It's the small caps that have really been lagging behind. And so a lot of folks are wondering, as we're shifting into a more, at least market-friendly type of an environment, which of course could change at any time. But the way things are right now, this might be more of a time when we look for the small caps to improve. Now, we're not seeing that yet, and I'll show you some charts, but we're seeing a bit of an improvement. However, the small caps are still underperforming when we compare them to other indexes. Before I get started, please know that I do post a video each day. That's where you're really going to get the big picture. I know the videos are longer. I try to keep them at 30 minutes or so. Lately, they've been drifting over into the 35, 40-minute category. And I know folks are busy, but I try to give the big picture look every day. Even when we have a slow day, I still go through all of the charts so that we can get a real grasp on what's happening right now, because these scenarios can shift slowly over a period of time. And I feel that daily analysis is where you really get the most insight. Also, there's a video on the YouTube and Rumble channel that talks about the program that I'm hoping to launch around June or so. I've just posted one video going over the program. I'm going to be posting other videos that go more in depth because it's quite an involved program. And there are reasons why I do what I do, and it's different than likely anything else that you've come across. So I want to be able to explain that just to give you some ideas if this is something that would interest you. I do put a PDF in the description of every video that I post. Some folks find that helpful to download and look at the slides that I use as well as the charts. And then I've incorporated in 2024 another video called the What to Watch video. After I go through the daily, weekly intermarket analysis video and the deep dive video, then I look at, okay, what am I really focused on right now? And so far it's been a weekly video, but the idea is if things really shift, I will do this on an as needed basis. So at least it'll be once a week, but it could be more than that. And then I do post the pivot points each day on the community tab on the YouTube channel. These are very helpful support and resistance levels that you may find helpful. One is a daily chart that lasts for the whole month. The other chart is an intraday chart, and that just lasts for that particular day. I do have a private Facebook group, not really active there. Not sure if I'm really going to continue with that as I go into the program area of things. But if you want to join that and offer some feedback, you're more than welcome to do so. And then I will be going through the results of the poll, and I'm having some problems posting with the poll. I post the question and the answers, and for the last couple of weeks, some of the answers aren't showing up there. So it's like a mystery. And I do really keep an eye on YouTube and Rumble comments. I like comments as long as they're pertaining to what is really going on in the video. I'm still having to play whack-a-mole on Rumble. This webinar or whatever craze is going through Fiverr or something where they say, oh, just go start copying and pasting comments into people's video on Rumble and talking about how you're an expert on video promotion. Well, the folks that actually subscribe to the channel, I let that sit for maybe an hour or two. And a lot of folks, they don't even do that. They're just going through all these channels, copying and pasting their little promotional message. Well, I delete those right away because I want this to be relevant to what's actually going on. And then I do post on Rumble as well. Here is the link. I was having some problems earlier in the week with Rumble. Then I had a little bit of a problem with YouTube. So if you are looking for a video and it should be posted, when you're looking for it and it's not there, feel free to jump over to the other platform. Okay, let's go back and talk about what happened. For the week, we were up 0.39%. Not real gangbuster. It was a very slow week. We were below average with volume, not only because of the one less trading day, but also each day was pretty sleepy. And it was mostly sideways moves that we saw, but things did go to the upside. And so we were up 0.39%, and that was enough to set a new all-time high on Thursday with the S&P. We were below average with volume, as I did mention, and we are positive with our technicals. We are looking a bit overextended. Now, that's the negative side. The positive side is when we're getting really high readings on some of our indicators, that can also suggest good momentum, and we can stay in an overextended reading on multiple indicators for a long time in a real positive environment. But just be aware of that, because at some point the market may come in and decide, rather than just going a little bit lower, drifting, that some real selling could end up coming into the market. As I record this, it's also Easter weekend. I want to wish everybody a happy Easter or Resurrection Day, however you refer to that. And there have been some issues with possible threats of terrorist attacks. And as I record this, nothing has happened yet, but we just want to keep an eye on that. And of course, if something like that does happen, that could have a real negative impact on the market. As far as our trend, on the weekly chart, we are still in a strengthening trending environment. The ADX is going up, it's above its moving average, and the green line is on top. On the daily charts, both in the short and intermediate term, we keep drifting lower as we've been chopping sideways. Some of our daily oscillators are just flatlining right now because the market really hasn't been moving all that much. And you could say, okay, maybe it's exhausted, maybe it's tired, but we're not seeing an awful lot of selling either. And so that's typically what will happen, is if we're going up and folks want to take profits, we see selling into strength, and that brings things down. We're just not seeing that to this point. We want to keep an eye on things to see if that does start to develop. So for the week, it was a holiday shortened week. It was quite a slow week on below average volume. Small caps, as I said, are showing some improvement. They were up 2.5%, and they were the leading index this past week. The S&P did close at another all-time high on Thursday. It was the end of the first quarter. So Thursday was one of those unique days where it was the end of the week, it was the end of the month, and it was also the end of the quarter. So we saw a whole coming together of lots of things at the same time. And then in Friday's session, which is another strange thing, even though the market was closed, we still had a very important inflation report that came out. The PCE prices and core PCE, which is something that the Fed really pays attention to, it came in pretty much as expected. So we're not seeing really any surprises there. Another thing that happened on Friday was Jerome Powell gave a speech, and in his comments, he pretty much confirmed this scenario that we've been going with lately, which tends to be more market friendly, that the Fed is probably done raising rates, and that we could look to as many as 3 rate cuts throughout between now and the end of 2024. And the market really likes that. Now, be aware of that, because for right now, it's reacting to what's happening in the economy. If some kind of black swan event happens, that could change this whole scenario really quickly. And I'm really hoping something like that doesn't happen, but in the real world, we have to at least be aware of those things. Mega caps and semiconductors were kind of under pressure a bit. They didn't have a really good week. What we're seeing is more broad market participation. We're seeing the mid caps doing well and the small caps doing well right now. And then, just as a bit of corporate news, because I'm from the Seattle area, Boeing announced that their CEO plans to step down at the end of 2024. A lot of problems going on in Boeing right now, and we'll see if some of those changes can get things back on the right track. Interest rates did end up declining for the week, not very much. We're at the 4.2% level, and the dollar is going back up. And so that could put some pressure on stocks. This is a chart that I've been showing for almost a year now, and because this is a very long-term chart, even though it hasn't been updated in a while, we're still in this downward slope when we look at this blue line. This is inflation going down, which is what we've been seeing. And that's positive, and the market likes that. What we're wondering is what is going to happen after this, because if you go from the mid to late 70s, even into the early 80s, we saw just massive inflation going up. That's why we keep an eye on gold. That's why we keep an eye on different areas of the market. We're looking for inflationary pressures to see, is that going to cause some kind of a problem? Now, we can project out and come up with our ideas, but what I do is I just look at what we have right now and we evaluate things. And then as things change, we reevaluate those things to come to new conclusions if we need to. But for right now, this is still looking positive. We did close at 4.2% for the 10-year yield. We're still above the 4.02%. So we're biting a bit into corporate profits there, according to this RenMac research. Here are the poll results. The first one, I don't have any answers for. It didn't show up. I typed them and they were there. But I just say, do you feel the extreme positive readings on the charts will lead to more advances or decline in the upcoming week? It's a mystery. Well, we were up slightly, and so far these extreme conditions that we're seeing are just suggesting good momentum. Then the next question, do you feel that rates will rise or fall in the upcoming week? 14% thought that they would rise. We ended up falling. 29% said that, and then most people thought that we were virtually unchanged. You could kind of go with that. We were at 4.22% a week ago. Now we're at 4.2%. So they fell, but not by very much. And the upcoming week, it's the end of the quarter. After seeing gains so far in 2024, do you feel that the S&P will be higher, lower, or pretty much unchanged? Meaning up or down less than 1% from now until the last trading day on Thursday. They were split across the board here. Half thought that we would be higher, half thought lower, virtually unchanged. We ended up being just marginally higher. Small caps continue to lag other indexes. Now that the Fed is turning more dovish, do you feel that this will help or hurt or have no impact on small caps? 60% said that that would help. And at this point, that's what appears to be happening, where 40% thought that it would actually end up hurting them. I don't really have much in the way of Isabel Net blog charts. They didn't update for Friday or Saturday, where I usually get the charts from. I do have a few posts that I found on Twitter that you might find interesting. This is Lance Roberts. He's from Real Investment Advice. He also has a show before every market open that lasts about an hour or so. Some of you might find that interesting. Sometimes I tune in, most of the time I don't. But he's pretty knowledgeable about things. And what he's pointing out here is this is a liquidity chart or liquidity index. And that's what we see here in red right here. And here's the S&P as well. And what we're seeing is a real wide distance between the two. And he says that the last time something like this happened, when we had a really wide spread between liquidity, that's the availability of funds and so forth, and more of a friendly interest rate environment, when we got really far apart, we saw a 10% correction after that. Now, is that going to happen this time? We don't know, but we just want to be aware of that. Also, another chart that he posted here with a tweet that says the easing of monetary conditions have supported the rally from the October 2022 lows. We also hit another low in October 2023. However, they have diverged recently, and we can see over on the right-hand side where we have the annual rate or percent change in the S&P. It's been going up, but monetary conditions have actually been going down to flattening out, and they're getting kind of far apart from each other. They tend to move in the same general direction. Typically, now they're tending to go in opposite directions. So are monetary conditions going to go back up, or is the S&P going to come down, or is there going to be some kind of a combination of the two? Then another one put out by Real Investment Advice. See, Friday was one of those holidays where a lot of things are closed, but a lot of things are not. So you had folks really posting a lot of things on Twitter because they still had to come to work that day, but the market was closed. So they figured, well, I have to do something here. Well, apparently Real Investment Advice, they needed to fill the time somehow. And this is the total monetary base, which I think this is a mistake because it says the S&P 500 on top, but at the bottom, this is the Wilshire 5000, which is a broader index, which I'll show you a chart of later. And really, this is just showing how we've been going up with stocks, whether you use the S&P or the Wilshire to do that. And this is just different events along the way that have been happening with the monetary base. And so this is more informational because sometimes we get far away, sometimes we get pretty close, rarely drops underneath, except at very strange times. And then this is a chart that I have been showing for quite a while, put out by NDR. And this is still the scenario that we're in, that the Fed may be able to cut rates at a slower pace, and that's more positive for stocks. If we do have some kind of a black swan event, that could mean that the Fed is cutting rates for different reasons, and that is more negative for stocks. There was one post from FactSet here where it says analysts made smaller cuts than average to their earnings per share estimates. We're starting to focus now on the first quarter of 2024, and earnings reports are going to start coming out pretty soon. And over here on the right-hand side of this chart, it just shows that, yeah, we were down. And that's what happens with analysts. When they're looking out into the future, they're all rosy and they're just going to have 20% growth in earnings and no debt and all their products are going to sell. Well, as that particular report gets closer and closer, they have to bring it down more to reality. And so we tend to see a lessening of the optimistic earnings projections or the earnings report, but they're doing it less than they were before. And then over on the right-hand side, the dashed blue line, that's price. That's what's been happening, where this is the gradual decline that we've been seeing in the earnings per share reports as they get adjusted. Then looking at our charts, here's the intraday chart. Starting on Monday, we were pretty much flat. It was really quite a boring week. We saw a little bit of a gain on Tuesday at the open, but then we really trailed off. This is when some kind of selling came in and really took us lower. Well, on Wednesday, we were able to gap higher and recoup that. We came down and filled the gap at the daily pivot and then saw some really strong buying going into the close. This is really where a lot of the strength came from, was the very end of Wednesday's session. We were sideways in Thursday's session. We saw a little bit of a blip up, but then we came right back down. So not an awful lot of movement, but we're still maintaining more of a positive stance here. So, and this is just the 4 trading days for the week. These are the indexes where we had the small caps doing the best. And we haven't seen that in a while. And we had the NASDAQ and NASDAQ 100 for the 4 trading days. They were actually down. This is not Friday to Friday. It's Monday through Thursday here. And we're seeing a little bit of profit taking, a little bit of resting right now in the Magnificent Seven and in the big stocks that have really been leading the market higher. We're also seeing value really show some improvement as well. Now, we like to see growth outperforming value, but value showing some improvement and mid caps and small caps looking better, that just shows there's more broad participation across the market, which is more positive. Going back to the beginning of the year, small caps are still doing the worst, but they're up on the year, and they pretty much gained that this past week. They were negative a week ago, year to date, where we still have the NASDAQ in first place, followed by the S&P, and then the NASDAQ 100 is in third place. But all of the indexes are up going back to the beginning of 2024. These are the sectors. I sorted this according to what was up the most because we had an up week. Where utilities bounced up, they've been under a lot of pressure. Energy, which is trying to make a bit of a comeback. And we're watching the energy sector because if we're getting into more of an inflationary environment and that ends up becoming a problem, that's usually when we see energy doing better. Healthcare, which is more defensive, that had an up week. So, and real estate, which has just been getting hammered. So these areas that have been under a lot of pressure, they saw a bit of a bounce back where you have consumer discretionary, communication, and tech. They were either virtually unchanged or actually declined over the past week. Then this next chart sorts this according to their scooter score. The better looking they are, the higher the score, going from 0 to 100, where we have the financial sector, industrials, which have been starting to come on, communication is still strong, and tech. And then at the bottom area, even though we saw a bit of a bounce here, utilities, discretionary, which has been a disappointment, and staples. These were the weaker areas as far as their scooter score. This is looking at the relative rotation graph. And again, I always remind folks to go back to your geometry class where the flat line here is the x-axis, and then we have the up and down line, which is the y-axis. When we're to the right of the y-axis, this is the plus area. So the things that are up in this box, they're looking the strongest. And we have industrials, even though they pulled back a little bit, actually they showed a little bit of strength. It's communication that has been quite strong. Now, this goes back over the last year and has been seeing a little bit of a trail off here. The financials, which have been doing well. We also have tech. These are some of the stronger areas where energy has been really showing some improvement, and like oil prices are still maintaining. They're not really gaining all that much right now, but they're still right around that 80 level. Then this goes back and just looks over the last year and compares the different indexes with the Wilshire 5000, where we have the S&P 100, which has been doing well. Those are the biggest stocks in the S&P 500, the NASDAQ 100, and I believe this is the S&P. It's kind of hard to read that one, where you have utilities. Transportation has been under a lot of pressure. The Dow Jones Composite Average, which has been doing well, but that's pretty much the Dow that's leading to that. And I'm not able to read this one in here. So, but the usual areas that we've been seeing. These are the sectors just for the 4 trading days where we saw real estate, utilities, and financials doing the best. The only areas that were down were communication and tech, and these have been the stronger areas up to this point. Going back to the beginning of the year, we're kind of split as far as what's positive and negative. We have communication in first place, and now energy, as it's been coming back, is in second place. Industrials, financial, and tech. Those are up, where all of the rest of the S&P 500 sectors are negative on the year. Here is sentiment, where we're coming in after Thursday with a reading of 71. Here's the historical chart where we're coming back up to this 75 level. And you have to look at the context of this. When we get a high reading and then we're coming down, that's usually when stocks are falling. When we're going back up, we still have a ways to go if we see more follow through upside here before we actually get to that extreme positive reading. But we can stay here. We've been here pretty much all of 2024 at very high readings as the market has been more positive. Here's the active asset managers. I don't have the other chart that I get from Isabel Net, but they're coming in pretty strong. Now, this is a week ago, and they're getting pretty optimistic about things. When we get above this red line, we follow this as it's moving in one direction or the other. But then when it gets above this red line, we say, okay, these folks, even though they're professionals, they may be getting a little too exuberant about current market conditions, and we could look at this topping out and starting to come back down. If this comes back down, that generally means that stocks are falling. And we're keeping an eye on the VIX, which on the daily chart, it's a little more pronounced, where we were seeing a series of higher lows. Even though stocks were going up, we saw the VIX going up. Well, we broke down below that, both on the daily chart and here on the weekly chart. When we look at the bar chart of the VIX, we're getting very low readings down here. And this just suggests there's not a lot of fear in the market. But we've been here now for most of 2024. If we see some pressure on stocks, we're likely to see the VIX go back up. The Ulcer Index also giving us very low readings and pretty much has been for all of 2024. The RIDEX bear bull ratio. When this is going up, that means folks are bearish when they use their RIDEX mutual funds. When this is coming down, they're more bullish, and they're getting pretty bullish right now as they're pretty optimistic about the market. We did get an update this past week from Investors Intelligence where we were seeing a reading up over 4. It declined. It's at 3.99 now. So it has come down a bit, but it's still giving us quite a positive reading. And the latest reading from the American Association of Individual Investors did show an improvement, but not necessarily giving us an extreme reading currently. This looks at 1 to 3 month T-bills, which you could pretty much call cash, and compares it with the tech sector. When this is going down, that means the tech sector is outperforming and the black line continues to go down. So in 2022, this is when we saw the black line going up. Now it's going back down, and that's more positive for tech. Looking at some economic things, we did get a reading in Thursday's session of the latest estimate for GDP, and then the GDP now updated to that. We're a little bit over 2% for GDP, according to this chart, where when you look at the range, it's about 2.5% to the upside and a little bit under 1% to the downside. The takeaway from this is that we're positive, and that's what we see here on the next chart. And we actually saw GDP pick up a little bit in the latest estimate. And so that's more the Goldilocks approach. When we can see economic growth that's not really robust, but it's healthy and we're at least growing while inflation is coming down. And that's what the market likes. And looking at the spread between risky and not as risky bonds, this continues to come down. If there was a lot of problems going on economically, we would see this going up, and it's really been declining now for quite some time. The latest reading from the Chicago National Financial Conditions Index, we're below the black line and declining. We get nervous if we go above the black line, and we pretty much have been below the black line ever since the COVID plunge. This hasn't been updated since the first part of February. This just shows that tightening standards for banks and getting loans is continuing to lessen. This was also updated March 8th. This is the real-time SOM Rural Recession Indicator. We're above the black line, but we're below the red line. We get nervous if we go above the red line. Similar thing here with the smooth U.S. recession probabilities. We're barely above the black line. We get nervous if we go above the red line, and we're far away from that right now. And then the Brave Butters, it was updated a little over a month ago now. It had been going up, but the latest reading has it coming back down. The closer we come back down to this black line, the more economic friendly that ends up being. Here's inflation. This will be the last time that you see all of the first quarter right here, because we're going to be beginning the second quarter, so the chart will start to redraw. And these are just the different adjustments that you've seen with inflation, whether it's CPI or PCE. We've been ticking up a little bit overall with the inflation expectations, but the market still considers it to be under control. We'll be really watching for the next CPI and PPI report that comes out, because the last one was really strong. But then the Fed came out and said, well, it looks like we might be interested in cutting interest rates, and we're probably not going to raise them anymore. The market threw out the negative and then brought in the positive from the Fed. Here is looking at the Fed. Their next meeting will be on May 1st, and this is as of the close on Thursday. There's a 95.8% chance that at the next meeting, the Fed is going to leave the rates unchanged. They're at 5.25 to 5.5 right now. And the way things look, they're going to be at 5.25 to 5.5 after that meeting. And we're getting a little bit more conviction here. Where the dark blue area, that's the reading right now. Then we have a day ago, a week ago, and a month ago. And this has been going up as more folks are starting to accept that. The idea of a rate cut had been higher, but is coming down. But then we look out into the June meeting, and this will be on June 12th. We're kind of across the board here, and we still have some time before that happens. But right now, the consensus is that we have a 61% chance that this is when the Fed will cut interest rates. That's why we'll be keeping an eye on the different economic reports to see if this percentage gets higher or lower. And this is how it's changed, this middle area. And you can see it bopping around a little bit. We saw this really move around as some economic reports came out. And as we get closer, the market will become a little bit more convinced of what's actually going to happen. We want to keep an eye on the Fed balance sheet. There's been some hinting that the Fed is going to stop quantitative tapering. All those bonds that they bought during the COVID plunge and trying to stimulate the economy, as of June 2022, they said, we're just going to, the ones that mature, we're just going to let them fall off our balance sheet. And when that happens, their balance sheet goes down, which is what we've been seeing. Well, if you look over here in the latest reading, the balance sheet's actually going back up, and we haven't seen that in quite a while. This may mean that the Fed is actually coming in and purchasing different bonds or mortgage-backed securities or what have you. Not really enough to really turn this back up yet, but the market would like this. Even though 15 years ago, Bernanke said, oh, the Fed would never do anything like this. Now it's become more common practice, and it's a way of really propping up the market. We also look at this on a year-over-year basis, where we're still declining when we compare where the balance sheet is now with where it was a year ago. Then looking at breadth, we're looking really solid here, and we're looking good on the daily charts too. When we look at the advanced decline line based on price and volume, and it's a little bit more pronounced on the daily charts, but we at this particular time, we're seeing volume stronger than price right now, and that can be a really good leading indicator. When we look at our new highs, new lows studies, we're pretty much pegged at the top, and we're running into that same issue with our daily chart where we can't really go any higher than where it is right now. We're starting to turn back up with the 10-week average. And you can see just the raw score here that there were a lot of new highs generated this past week and almost no new lows. The advanced decline ratio is turning back up and above zero, so that's positive. And so volume from this perspective is looking positive. The accumulation distribution, we're a little bit negative. We dropped off a little bit on the daily chart, where when we look at the weekly chart here, we're still above the advancing moving average. So in the bigger picture, the smart money is still coming in and buying, but they kind of took this past week off. And so we're seeing a little bit of weakness in the daily charts. Then keeping an eye on the trend, this is the ADX. Now we are going up, and where we get a little bit nervous is when the ADX gets above 40. We're currently at 39.35 right now. This is just showing that it's a strengthening trend because it's above the moving average. The green line is on top, so we would default to positive. The Erin indicator is also quite positive. We have the green line on top, that's buyers. The red line is on bottom, that's sellers. When we compare the two, the oscillators above zero and continuing to go up, we're actually getting kind of an extreme positive reading on the daily chart. Mass index is not generating a signal. Here's our daily chart, and I went back to a 3-year view here because hopefully now that April is starting, it'll kind of clear out some of this mess that we saw, where we do have some pivot points below current price that may act as support if we pull back. We also have this R1 level above current price, which may act as resistance if we continue to go up. And you can see the last 4 days here for the week, we were below average with volume. We're still positive when we look at the Keller market model across all the different indexes, the S&P, the mid caps, small caps, and the NASDAQ 100, and all different time frames, short, intermediate, and long term. This is the decision point scorecard where we recently saw a change with the short-term PMO. So we're positive in the short and intermediate term. With their trend models, we're positive across the board here. We're still negative with the long-term trend with the PMO. Here's the trend channel. We're well above the midpoint and advancing. So this is looking quite positive going back to 2009. This is a chart that I've really been honing in on, but we're starting to break above this R1 level. We came up here, hit it, came back, and then we danced along this level for a while. Now we're starting to break above this. What we're wondering is if we start to see some weakness in the market and we come back down, have we been above this long enough now for this to actually act as support? Then looking at our trend, we are still positive. We're almost just parabolic here with the price of the S&P on the weekly chart. The moving average, the red line, that's also going up, and price is above the moving average. So this is quite positive. When we use our moving average crossover, we're also positive with the blue line. That's a 13-week moving average is above the 50-week moving average, and price is above both moving averages. So that's quite positive as well. We're above zero and advancing with the McClellan oscillator on the weekly chart. We're getting rather extreme with the summation index based on price, but this could still go higher than where it's at right now. We're positive. We're above zero based on volume and advancing. And then we look at the Swenlin trading oscillator. We actually declined a little bit based on price and volume, but both are still above zero. So this is still positive. And with our bullish percent index, seeing pretty much the same reading here as we're seeing on the daily chart, is we're above the 70 level. And that's when we are a little bit concerned that we're going a little too extreme with the reading. But it's okay to go with that as long as the bullish percent index continues to go up. It's when it rolls over, that's when we start to get a little nervous. And when it drops below 70, that's actually a sell signal for the BPI. When we look at the price momentum oscillator on the weekly chart, we're flatlining on the daily charts, but we're looking really solid here on the weekly chart, but we're getting up to an extreme rating, but we could still go above where we're at. We're advancing based on price and volume. We're seeing an improvement with the PMOs that are rising. So these are the internal measures inside of the price momentum oscillator. We continue to go up with the buy signals, and we're going up with the PMOs above zero, and we're above this green line, but we could still go higher, but we are starting to get extreme positive. When we look at the Bollinger Bands, we're just looking really solid here. We're above the midpoint's going up. There's kind of a wide separation between the bands here as we've been going higher. Then we look at the percent B, which measures when we close either above or below one of the Bollinger Bands. We're positive since we're above the midpoint, but we're not extreme right now. Here are the oscillators. We saw this a week ago. We're starting to turn down with the slope oscillator. And on the daily charts and on the weekly chart here, this is our touchiest oscillator. But when we look at the TSI, another short-term oscillator, it's continuing to go up. But both of these are giving us really, really extreme readings. Now, this can suggest good momentum. This can also suggest that we're overbought and at some point may see a pullback. The intermediate term with the MACD, the PMO, and PPO are still looking positive. And then our long-term view of the oscillators, we're going up with the tricks and the KST. But you can see all of these are giving us very, very high readings. And we're seeing that on the daily charts as well. The chicken money flow, it's actually showing some weakness and has turned negative on the daily chart, where when we look at this on the weekly chart, it is still looking positive, maybe a little too positive. We're getting a higher reading than from what we've seen in the past. And then chicken oscillator is coming down after giving us an extreme positive. This has also turned negative already on the daily charts. The force index is above zero and advancing. That's positive. We're looking extreme positive with the money flow indicator. We were up on the week, although not as much as the previous week, but we're still above the midpoint when we go over the 1 week rate of change. The 50-week rate of change, we're above this red line, which sometimes that means that we've been going up a little too far, too fast, but we could still go higher than where we're at right now. The RSI is starting to get extreme positive, where we're not extreme with the RSI indicators we use on the daily charts. The weekly special K chart is going back up, but it's still negative. It has not been able to cross above the red moving average. The Stochk RSI is extreme positive, and the Williams percent R is extreme positive, and we're seeing that on the daily charts too. We're coming down, but still extreme positive with the ultimate oscillator. The Vortex showing some weakness on the daily chart, just kind of drifting lower, but still positive, where we did get a really extreme positive reading here, and we've been coming back down. The Copic curve flatlining on the daily chart, trying to turn up, but still kind of negative here on the weekly chart. And we're far above all these fib levels and all these longer term moving averages. So these would act as support levels if we really start to move down. And when we look at the 253 simple moving average of the equity put call ratio, we're ticking up a little bit, but overall we have been declining, and that is positive for the market. We're also turning down with the ratio between the VIX and the 3-month average of the VIX, where for most of 2024, we were going up. Now we're starting to come back down. That's also positive. On a trending basis, the Heiken Ashi, just open candles all the way going higher. That's positive. We're pointed up and looking black here with the Kegi chart, so that is positive. The Renko chart has open blocks. That's positive. And the 3-line break is open as well with the candles. That is positive. The ease of movement, we're flattening out here, and this tries to measure the path of least resistance. Is it to the upside or downside? It's positive, but it has been going sideways lately. We also look up on top a thing called equivolume, a chart here, where this tries to measure price and volume together. If it's green, it's up. If it's red, it's down. And the thicker or wider the candle, that means the more volume that actually went into that move. No changes here on the point and figure chart. We are getting this high pole reading on the daily chart, suggesting that maybe we've gone up too much here. But nonetheless, this is still looking positive on both the daily chart and the weekly chart. When we look at our momentum, the long term we're going up, intermediate term kind of flattening out a little bit. And we actually declined a little bit in the short term. But this is, even the short term is still a weekly chart. And then we did enter into what could be now called a new 50-day cycle. It looked like maybe we were going to see some weakness, but we continued to go up. We are going back over to neutral now with the Elder's Impulse system on the weekly chart. We're still positive on the daily chart, and the parabolic SAR continues to be positive with the dots underneath. We continue to be positive on the daily chart. And we're coming into April now, where it's not necessarily on a percentage basis as strong as March, but it still ends up being a positive month out overall, where we tend to see 2.6% advance historically. This is just looking at the different indexes where we're just setting all-time highs here with the S&P, looking pretty solid with the mid caps, just coming off of setting all-time highs. The small caps, this is what a lot of folks are really watching now. They have quite a ways to go to get back to their all-time high, but they are seeing some improvement. The Dow is in an uptrend and coming off of recent all-time highs. The NASDAQ also recent all-time highs and in an uptrend. The NASDAQ 100, not a real solid week, was actually down on the week, but still in a longer-term uptrend. Here's a weekly chart of the QQQs where we're kind of flattening out here as some of the... Sorry about that. I had a little thing crash here. Thank you to the cat. But as the bigger stocks are taking a bit of a breather and folks are going in and buying some of the other stocks that are now available, the mid caps are looking pretty solid. And really, this has been a stronger part of the market in 2024. Here are the small caps where we are in an uptrend, both on the daily and weekly charts, but we just barely were able to close above this high that we set back in December, but we still have a ways to go to get back to this previous all-time high. The NYSE is in an uptrend. That's a broad market measure. And then I'm starting to bring this back in with the Wilshire 5000, another broad market measure, which is really in a solid uptrend now. All stocks looks at in stocks in the US as well as internationally. That continues to be positive. The 30 biggest software companies are in an uptrend, but still have a ways to go to get back to their all-time highs. The FANG index has been chopping more or less sideways, but still in an uptrend. ARC just really hasn't been participating all that much. It's in an uptrend, but it's really been chopping mainly sideways in 2024. Want to keep an eye on the banks just in case there's more news that's going to come out. On the weekly chart, we're starting to get extreme positive with the RSI. We have been going up when we look at the weekly bars. We're also showing where momentum continues to be positive. And deposits, we're actually seeing a little bit of money going back into markets now, as folks are feeling a little more confident about that. This is just a blanket look at Dow theory, where we're setting recent all-time highs with the Dow. We have been going sideways now with the transport. So the big question marks as far as stocks are concerned with the way things look right now is, are the transports going to kick into gear? And there's a joke in there somewhere. And what about the small caps? These are the two lagging areas that we've been seeing. Are we going to see a change going forward if the Fed is actually pivoting, continues to pivot over to more of a dovish stance? On the broad market, the CRB, and this might be causing a little bit of problems here. We're seeing commodities going back up. This could be inflationary. And on the daily chart and on the weekly chart, we're starting to see a golden cross here. Oil has been going up, which could also be inflationary. Copper was virtually unchanged on the week, and it's trying to show some improvement here as the economy looking forward is tending to look better. The dollar is going back up. This could also pressure stocks right now. We are seeing a golden cross on the daily chart. We're above both the moving averages here, but not enough to generate a golden cross on the weekly chart. Gold also continues to break out. And silver is still in a downtrend and pretty much chopping sideways and has yet to really break out to the upside. Then looking at bonds, we are continuing to be in an uptrend when we look at the price of bonds with the total bond ETF. When we do a monthly look at the stock to bond ratio, stocks continue to outperform. And we're coming back down, but we're still a little bit positive when we take the 1 month yield and subtract the 3 month yield, where we should always get a negative answer, but we've been getting a positive answer for quite some time. Here's a daily look at the yields where they have been coming down recently. And here's a weekly chart at international yields with the US, UK, and German rates not really changing all that much, but coming down slightly. We saw a little bit of a decrease with the red line. That's the Japanese yield. And then I've been showing this since last October. This is when we hit 5% with the 10-year yield. And now we've been coming back down since then. The other times that this happened, that was something negative that happened. But as I also like to point out, there have been other spikes along the way here that didn't lead to anything. And so we just have a big question mark here. We just want to be aware of this. And this also kind of shows that same thing. When you look at real rates, which takes inflation into account, it looks like we topped out, we're coming down. And sometimes this marked some kind of a negative event. Well, this has happened back in October now, and we're getting further away from that. And at least to this point, no other shoe, first shoe or second shoe, has really dropped yet. Then some relative studies. This is the intermarket analysis chart going back to the beginning of the year, where oil is still doing the best, followed by stocks, gold, the dollar, and the price of bonds continues to be negative on the year. When we look at a ratio between the NASDAQ 100 and the S&P, now the NASDAQ 100 has been the real leader. The S&P has more stocks and more value in it. So that's why we're seeing this ratio coming down, as the S&P, in the short term anyway, has been outperforming the NASDAQ 100. The S&P 100 also pulling back a little bit when compared to the S&P 500, but longer term is still outperforming. Growth to value pulling back a little bit, but we're still seeing growth outperforming value. And gold, even though it's been breaking out and setting all-time highs, it's still underperforming the S&P 500. And it's been outperforming the dollar. Now, the dollar's been going back up. So we're seeing this coming down just a little bit on the daily chart. It's not as pronounced here. We actually broke out above this long-term trend line going back to 2011. And the gold fans, they're just sure that what they've been waiting for and what they've been saying is going to happen any day now is finally starting to happen. And this is another measure showing how bonds are underperforming stocks. Low volatility stocks, even though they're in an uptrend by themselves, they continue to underperform the S&P 500. Discretionary pulling back a little bit, but is still outperforming staples. Now, both discretionary and staples are in uptrends on their own. We want to see discretionary doing better, but so far in 2024, it's been really underperforming, and a lot of that has to do with Tesla that's been under pressure. Energy is still underperforming tech, but it has been bouncing back lately. We want to keep an eye on energy and gold. Those are inflationary type things that we watch for. Then longer term, this is the NYSE breadth thrust. We're still working off of that signal that was generated in October 2022. That ended up being the low, and so this is still indefinitely on the books. We're also working off of at least one swag NYSE breadth thrust. We're more than a year out now from the first signal that was triggered, but we still are within that window of the second trigger that was happened back in October of 2023. We're still looking positive with the Zohorchak method. We're still on a full-on buy signal. This is a longer-term trend line going back to the 1987 crash. We're still well above this. Here's a shorter-term look at that same chart, and we're well above this. So now if we start to come back down, we've been above this longer for a fairly long time now. So this could end up acting as support. We're also looking at the NYSE new highs minus the new lows. And then this is a 50-period moving average of that. And this is continuing to go up. This is showing internal strength in the market. This is also another way of looking inside the S&P to show internal strength. We're above zero and going up as the S&P has been going up. And here's the NASDAQ 100 weekly chart. We're still above this long-term trend line going back to 2009. Here's the big one that the bears are really latching onto, but it really hasn't started to materialize yet. This is the ratio between the NASDAQ 100 and the Dow. We came up to this level back in 2000 and then crashed. We came up to this in 2021 and then had the bear market. We're right around that level right now. We actually declined a little bit because the NASDAQ 100 did underperform this past week. We're also keeping an eye on the QQQs and the small caps, where this actually came down a little bit after giving us a pretty high reading. This is a longer term chart that we want to keep an eye on. And then the NASDAQ new highs minus the new lows cumulative has been turning up after it had been declining for years. it is seeing an improvement. And then we want to keep an eye on the 3-month yield. When we topped out back in 2007, that was right before the great financial crisis. We're above that level now, and we were starting to come back down, but we continue to go sideways right here. We want to keep an eye on this. If something happens, if there's some kind of an event that will affect, let's say, the banks or the financial sector, we're going to see this drop and drop really fast. The fact that this is hanging in there for right now is positive. Then seasonality, and we've kind of had to put that on the back burner for right now. We really didn't follow seasonality in the month of March. We're actually closer to this. This is Dan Bird's chart where we didn't really see much of a down move into the middle part of March, but then we saw things going back up. Now we're starting to enter into April, where we often see some strength in the early part of April, going into the latter part of April before we possibly see some weakness in May. That's where you get the old adage, sell in May and go away. So, and this is what we've been watching too. 1982 and 2023 were mirroring each other. We were seeing a bounce up both times, and so far we seem to be following along with that fairly well in 2024. So thank you. I hope you found this helpful. Because of the holiday, I don't have some of the charts that I usually have available to me. After this, I will be preparing the intermarket analysis video update, as well as the deep dive video and the what to watch video. So have a very good holiday weekend, and I will talk to you in the next video.